Checking the Nasdaq right now, it's down 215 points. While investors have really been on the edge of their seats with wild recent stock market swings, there's one area investors are starving to invest in, but they have to fight over scraps. You have to look all the way back to 1996 to see the height of the initial public offering or IPO market. Investors could buy into 679 market debuts that year. But since then, that number has plummeted, no thanks to multiple financial crises, the worst, of course, being 2008, when we hit rock bottom with just 14 IPOs. Fast forward to this year. IPOs are back over 143 year to date going public, but still not at the pre-dot-com bubble highs. And the Nasdaq CEO has said, we will never get back to the numbers in the 600s if we don't take the weed whacker to the red tape public company's face. That CEO is Adena Friedman, and she's with us live. Great to see you.
It's great to see you, too.
We have seen healthier IPO markets and much worse IPO markets. Right now, for the Nasdaq, you've actually had a really solid year. But what is the problem here? Why are we not seeing companies, the Ubers of the world and the Postmates of the world, why are they waiting years and years to go public?
Well, I do want to point out the fact that this year has been a good year for Nasdaq. We have had actually 160 IPOs come to Nasdaq so far this year versus 96 this time last year.
Right.
And we have a 70% win rate overall for the year, 76% for the quarter. So we're really pleased with how we're performing. However, this year and 2014 are kind of standout years. If you look back over 10 to 15 years, those are really the only two really healthy years. And you're right, we're not nowhere near where we were in the 90s. So really, regulation has a lot to do with it. There is a lot of private capital out there to invest in these companies, these growth companies. But the act of going public today is such a difficult decision, and there's so many new obligations and regulations that are placed on companies when they go public. It makes it very, very much a difficult decision today.
Uber, of course, has been in the business for 9 years. There's Airbnb. We're all waiting for those, not to mention, as I said, Postmates. But Warren Buffett and Jamie Dimon had put out this op-ed saying it's time to stop forcing companies to constantly stop what they're doing and look at things like, every detail, and you have to put out every material piece of news that you have. So here's my question. Should we eliminate quarterly earnings reports?
Well, I think that their advice was also to focus on quarterly guidance, which means that every single quarter you're trying to tell investors what the next quarter is going to look like, which then creates a real short-term orientation amongst the investors. I do think having an opportunity to talk to your investors, remembering that they are your owners, and having an opportunity to talk to them every quarter is probably a good discipline to have. But the amount of information, the mound of paper that we have to create every quarter seems like it's really, there's just too much of it as compared to the value that the investors get from it.
Okay, so let me just be clear. You feel that we should continue to have quarterly earnings reports, but that CEOs shouldn't have to take a guess as to what kind of headlines they'll be hit with or not hit with in the coming quarter.
I think that exactly. So I think that the guidance is if you guide to the short term, you end up, the investors start to look at the short term. So I think that their advice is to guide to the longer term. We provide 3 to 5 year outlook on our revenues, and we guide to an annual expense number, because that's the one thing that we know we can control. But it allows the investors to think of us and allows me to have a longer-term conversation with the investors, even though every quarter I have a report card that I have to deliver. I think that the one thing also is 10 Qs, those really long quarterly filings. Very often investors don't look at those. So if you can just use your earnings reports and then at the end of the year have a comprehensive document, that would save a lot of paper, a lot of time, and a lot of energy.
I don't expect you to open up your playbook here. I'm not the New England Patriots cheating and looking with a camera. Sorry, Patriots fans, but when you're looking at an Airbnb and you're saying, we want to pitch them to list on the Nasdaq, how do you kick into gear?
Sure. Well, the big thing is we support companies all the way through their life cycle. So we start actually when they're private companies, and we do have something called the Nasdaq Private Market that facilitates secondary transactions in private companies led by the companies. We develop a relationship with them. Then as they're thinking about tapping the public markets, we provide them a whole host of information and knowledge around the investor base and what they can expect from investors as they go public. Then we have an amazing first day that allows them to celebrate the event, but also gets them a huge branding opportunity. And then for many years thereafter, not only do we provide great marketing and visibility support, but we also help them with their investor relations. They have to grow up into a new type of company with a new constituent that they're having to communicate to. And we have a whole host of analysts and technology that allow them to do a really great job of managing their new owners. And so we're excited. We're very proud of that.
Well, you're doing things right. Your profits are up. Your earnings were strong. What are the odds you get the Airbnb?
Well, we don't talk about any individual things, but we obviously would love every company to come to Nasdaq, and we are very proud of the fact that so far this year, 90% of VC-backed companies have chosen to come to Nasdaq.
Good to see you, Adena. Thank you very much.
Thank you.
Adena Friedman.